Welcome to the companion webinar of Run with the Bulls, an illustrated guide to the stock market, trading strategies, and risk management for beginners. Today we will cover the market cycle, base counting, divergences and convergences, DMI, ADX, and MACD indicators, and we will also talk about entry and exit strategies in momentum trades. A market cycle refers to the pattern that emerges as markets run their course from trough to the peak and back to the trough. It includes a bull market where stock prices are rising and the market sentiment is positive, and a bear market where stock prices are falling and the market sentiment is negative. It also includes periods of accumulation and distribution when the market moves within a horizontal range. Being able to identify when the bull market is about to begin and when it is about to end within a market cycle will help a trader time the entry and exit in long trades. Being able to identify the beginning and the end of a bear market will also help the trader time the opening and closing of short positions. The stages of a market cycle include the accumulation, the markup, the distribution, and the markdown stages. So what do we do at each stage of the market cycle? During the accumulation stage, we monitor the on-balance volume, we put the stock on watch list for a possible bullish reversal, and we assess fundamental developments. During the markup stage, we go long, we use trend trading strategies, we watch out for signs of a bearish reversal, and signs whether the trend is about to end. During the distribution stage, we avoid or we sell the position. During the markdown stage, we either go short or we avoid the position. And then we wait for another accumulation stage to happen, and then we keep monitoring the stock for trend reversals and possible fundamental developments. Here's an example of the market cycle within a real chart. During the accumulation stage, we wait for signals to buy in terms of higher highs and higher lows and bullish crossovers and increasing RSI. During the markup stage, the momentum traders will enter during breakouts. Swing traders will buy at pullbacks to the 20-period moving average, while position traders can buy at pullbacks towards the 50-period moving average. In the distribution stage, momentum traders and position traders would opt to sell and avoid the position. Swing traders can still trade the range, but note that this is already a highly risky swing trade. During the markdown stage, the only way to earn is through shorting the market. If you intend to go long on the market, this is a stage that you should avoid. How do we know ahead of time when price is about to enter a new stage in the market cycle? A great way to find these inflection points is through divergences. In order to find divergences, an indicator such as the relative strength index is used. When the price and the indicator are both moving in the same direction, such as both are making higher highs and higher lows, then they are in convergence. However, when the price and indicator are moving in opposite directions, such as the price is making lower lows and the indicator is making higher lows, or that the price is making higher lows but the indicator is making lower lows, then they are in divergence. Divergences are valuable tools to employ in a trending market and are best used within the study of market cycles. There are two kinds of divergences, regular and hidden. There are also two biases for divergences, bullish and bearish. While regular divergences signal a change in trend, hidden divergences signal continuation of trend. This chart of the UK 100 market cycle shows how divergences signal the beginning and ending of stages within a market cycle. The price was on a downtrend, and then a bullish divergence was spotted at point 1. This means that the bears are weakening. There is likely to be accumulation within this area. A bullish reversal followed. The price broke above the downtrend line and the 50 EMA line at point 2, while the relative strength index also crossed above 50 at point 3. Prices at the start of the markup stage. There was strong upward move. A hidden bullish divergence is spotted at point 4, which signals a continuation of the trend. At point 5, a regular bearish divergence was spotted. A regular bearish divergence is a warning that the bulls are weakening and that the distribution stage may soon begin. Price moved sideways, creating a trading range as the big money took profits but also prevented the price from dropping so that they could distribute the shares at higher prices. So once the big money have liquidated their positions, the distribution stage is concluded. Price enters the markdown stage as the latecomers are selling down to cut their losses or to protect their profits. In a valid downtrend, both the price and indicator are making lower highs. A hidden bearish divergence at point 6 signaled the continuation of the downtrend. At point 7, a regular bullish divergence was spotted, which was followed by a trend reversal. At point 8, a hidden bullish divergence signaled the continuation of the trend, and at point 9, a regular bearish divergence signaled another possible bearish reversal. I plotted regular and hidden divergences within this chart, along with the stages of the market cycle. During the accumulation stage, the price is experiencing a sideways movement. Using the RSI, we find that the price made lower lows and the indicator is making higher lows. This is called a bullish divergence, which tells us that the downtrend is weakening. However, a bullish reversal should not be taken as an absolute sign of reversal. It must be confirmed by a price breakout above the accumulation stage. We could also use moving average crossovers and a volume breakout and higher highs and higher lows in price as confirmation. Once the breakout is confirmed, price enters the markup stage. Within this stage, price is on an uptrend. Price makes higher lows while the RSI is also making higher lows. There's an agreement between the price and indicator. This is called a bullish convergence. As long as price and RSI agree, the probability of a continued uptrend is increased. Within this uptrend, we might possibly find a gem of a signal which is called a hidden divergence. A hidden divergence is a valuable tool for a trend trader because it signals that price is likely to continue on to existing trend. When price is making a higher low but the indicator is making a lower low, then we have a bullish hidden divergence. In an uptrend, a bullish hidden divergence tells the trader that price is more likely to continue with its uptrend. A bullish hidden divergence is like the Easter eggs that you luckily come across in a video game. It is a bonus item that will boost your chances of success. As price advances, traders will wonder whether the markup stage will end. A regular bearish divergence may provide clues. It occurs when price makes higher highs and the indicator is making lower highs. A bearish divergence happens when the price is increasing rapidly, which is characteristic of price runs that are about to top out. The fastest moves often happen at the end of the markup stage. However, note that this is not an absolute signal to sell. It is merely a warning that the rally is weakening. Price may continue to move up even if the signal is present. It must be combined with other signals for confirmation. Now, once a distribution stage is confirmed, price enters a downtrend. In a valid downtrend, both the price and the indicator are making lower highs. The indicator and the price are in agreement. This is called the bearish convergence. This supports the possibility that price is in a markdown stage. Within this decline, we may encounter hidden bearish divergences that signal the continuation of the downtrend. A bearish hidden divergence happens when price is making lower highs, but the indicator is making higher highs. Once the downtrend ends, price moves sideways. This could be the start of a new market cycle. So divergences are additional tools that the trader or investor could use to time entry and exit into the market. This is additionally powerful when combined with an analysis of the market cycle. However, it should be noted that divergences only provide probabilities and not certainties. Understanding divergence can lead to most profitable trades because it helps the trader recognize and respond to changes in price action. The markup stage is typically divided into 4 to 5 bases. A base is a consolidation pattern where price trades within a range. When price breaks above a base, it makes a strong rally and then consolidates into a higher base. The fifth or sometimes fourth base marks the end of the markup stage. Momentum traders could enter and exit strategically and take advantage of momentum during breakouts while avoiding long consolidations within the bases. Position traders could simply hold until there is a sign of topping out between bases 4 and 5. What are the conditions that prepare a stock for the markup stage? First is a bullish divergence, that means that the downward momentum is weakening and is a good candidate for reversal. Second, volume precedes price. There are unusually high volumes prior to the move. Volume breaks above the 10-day volume high. This means that the market is starting to express interest. There is a bullish crossover where the 50-period moving average is higher than the 150-period moving average and higher than the 200-period moving average, and price trends above 20 MA after the crossover. For confirmation, price breaks the 52-week high, multi-year high, or all-time high. When price breaks above duration highs on higher than average volume, this means that the demand remains high even as price increases. If all these conditions are met, then the probability of a successful breakout is higher. Counting the bases within a stage is helpful in order to assess the maturity of a trend, and it provides a framework from which price moves within market cycles. Combining momentum indicators and base counting provides clear insight into both the direction of price and the strength of the price move. Counting the bases within a stage is helpful in order to assess the maturity of a trend, and it provides a framework from which price moves within market cycles. Combining momentum indicators and base counting provides clear insight into both the direction of price and the strength of the price move. The chart shows an example of price moving from accumulation to the markup to the distribution stages, and on the way up, it created 6 bases. Here's another example of a chart where price moved from the distribution stage to the markdown stage to another accumulation stage, and on the way down, it created 4 bases. Two indicators that could be very useful for momentum traders are the DMI indicator, or the directional movement index, and the MACD indicator, or the moving average convergence divergence indicator. So directional movement index serves two important purposes. First, it identifies where the market is trending. Second, it provides the direction and strength of the trend and provides entry and exit signals. So we know that when the blue line is above the yellow line, or the positive DI is above the negative DI, the buyers are stronger than the sellers. And if the ADX is 20 or above, then the trend is strong. So the larger the spread is between the two primary lines, the positive and negative DI, the stronger the price trend. Here's an example of a chart showing the market cycle with the bullish side, or the markup stage, and the bearish side, or the markdown stage. Note how in the bullish side, the positive DMI, or the blue line, is dominant, and the ADX is increasing. This shows that the buyers are strong. In the bearish side, the negative DMI is dominant. This is the yellow line. It also shows that the ADX is increasing, showing the strength of the sellers. MACD is another indicator that the momentum trader could use. The MACD indicator identifies the direction of the trend. If the fast line is below the slow line, you have a downtrend. If the fast line is above the slow line, we have an uptrend. chart of Bitcoin, we combine the MACD, the DMI and ADX indicators along with base counting to assess the direction of price and the strength of the trend. So in A, we see that there's a bullish crossover on the moving averages. The 10 EMA is above the 20 and the 50 EMA. The positive DI is above the negative DI, and the ADX is greater than 20. The MACD is also increasing. It is above 0. So your strategy here is to buy or go long because there's also a volume breakout. In B, we see that the ADX is above the positive and negative DI. It is also above 20. However, the positive DI and the ADX are pointing down. Price is below the 10 EMA. The MACD is greater than 0 though, but there's already a bearish crossover. So this tells us that the medium-term trend is still up, but the short-term trend is weakening. So we can take profits at 2. The price started forming a sideways consolidation. This created base 1. Now in C, after price traded within a range for 3 months, there was a bullish moving average crossover. The 10 EMA is higher than the 20 and the 50 EMA. There was a base 1 breakout, and the ADX is above 20 and the positive DI is above the negative DI. This shows us that the buyers are in control. The MACD is greater than 0 and it has a bullish crossover in 3. Then price broke above base 1 along with strong volume. Your strategy here is to buy or go long. Now in D, the ADX is again above the positive and negative DI. The positive DI and the ADX is pointing down. So this is not a very good signal. When the ADX points down, it means that the strength of the trend is weakening. The price is below the 10 EMA. The MACD is greater than 0, so the trend is still upward. We see this in 4. No, medium-term trend is still up, but the short-term trend is weakening. So we could take profits. So this action happened all within base 2. This was a sideways consolidation. We take profits when the momentum has weakened and starts to consolidate sideways. This is what a momentum trader would do, but a trend trader would rather just hold as long as the price is above the 50 EMA line. Now in E, the 10 EMA is greater than the 20 and the 50, and then there was a base 2 breakout. Again, the positive DI is above the negative DI and the ADX is also increasing and is above 20. The MACD is also positive and it has a bullish crossover in 5. There's a volume breakout, therefore we buy and go long. Now in F, the ADX is greater than positive and negative DI. The positive DI and the ADX is pointing down. Price is below 10 EMA again. MACD made a bearish crossover at 6. So you take profits. Price then consolidated within base 3. Now in G, we have another bullish crossover of the moving averages, and then there's a breakout above base 3. The ADX is strong above 20 and the buyers are in control. The MACD is also above 0 and has a bullish crossover in 7. Take profits if already in the position. Buy with tight stops due to the bearish volume divergence if you don't have a position yet. So this is the sign of a maturing trend, or you can just watch the movement because we're already in base 3 and it is already a high risk base. So whether you will enter or hold your position depends on your risk appetite. Now in H, the ADX is greater than the positive and the negative DI, so that's not a good sign because every time ADX is higher than the positive and negative DI, then there's huge probability that it will start to weaken. It's already at the peak. Price is below the 10 EMA, which is also a negative signal or a bearish signal. The MACD also did a bearish crossover in 8, so you take profits at H. In I, the ADX is less than the positive DI. ADX is less than 20, which means a weakened strength or weakened trend. Price is below the 10 EMA, which is also bearish. The MACD is neutral, but it is still above 0 in number 10. So you just avoid this because the signals are mixed. In addition to this, we already see a bearish volume divergence and also a bearish divergence on the MACD. While price is going up, these two indicators are going down. In J, the ADX is again less than the positive and the negative DI, and the ADX is also less than 20. The sellers are in control because the negative DI is above the positive DI. The price is oscillating around the moving averages. The MACD is less than 0 in number 10, and and also we find a head and shoulders pattern. So we avoid this. In K, the sellers are in control as the negative DI or the yellow line is above the blue line or the positive DI. The ADX is greater than 20, which means that the sellers are strong this time. The price is below the moving averages. The MACD is below 0 in 11, so we avoid or we go short. In L, the 10 EMA is greater than the 20 and the 50 EMA. The positive DI is greater than the negative DI. The ADX is greater than 20 and increasing. The MACD is greater than 0 and has a bullish crossover. So in letter I, we go long because of the breakout. So the price of Bitcoin actually went further higher and reached a high of 67,000 on this bullish crossover. So we can see the bearish and the bullish parts of this chart. The bullish parts is where the DI positive is higher than the negative DI and the MACD is greater than 0. The bearish part of the chart is where the negative DI is higher than the positive DI and the MACD is less than 0. So the use of both the MACD and the DMI indicators along with the study of volume is important to assess whether breakouts have the capability of bringing prices higher or whether it is doomed to fail. So an important application of the MACD indicator is the ability to spot the signs of a possible reversal before even crossovers can take place. Divergences between the MACD and the price could be found at the throes of the market cycle and could signal a bullish trend reversal. It could also be found at the peak of the market cycle, which warns of a bearish trend reversal. Now here's another chart. The price formed 6 bases on the way up. Every time moving averages give a bullish crossover, there's also a bullish crossover in the MACD, and the positive DI is above the negative DI, and the ADX is pointing upward. And every time there's a price breakout, it has to be accompanied by volume, and also it has to be accompanied by buy signals from the MACD and the DMI indicators. So once you find warning signals in terms of bearish divergences in MACDs or the volume or sell signals from the MACD or DMI indicators, also take a look at the maturity of the trend. If price is about to end, if it's from the 4th to the 6th basis already, then you should be getting ready to get out of the position. In addition, if you see that price had already formed 3 bases and is already about to form the 4th base, then it is not a good idea to enter a position anymore because the trend is about to reverse. If you will enter a position, make sure it's a short-term position and you will have tight stops if the price fails to make higher highs, especially if there's already a very bearish divergence on the volume or in any of the indicators. It is not to say that you should sell your position quickly. It just means that you should have tighter stops on the way up if the trend is almost at the end. Again, counting the bases within the trend will help you know whether the trend has already matured or whether it is only starting. Within each base, one of the important signals that tells us that price is about to break out is when the price range tightens and the moving averages contract. This tightening of price ranges and the contraction of moving averages are called squeezes. It indicates that the price is about to break out in one direction and the corresponding move is going to be a strong breakout. In this chart, we see bullish breakouts above bases. These are good entry points for a momentum trader. Note that prior to the breakouts, we see a tightening of the price ranges and the moving averages are also tightly squeezed together. Along with this, the DMI indicator is bullish and we see moving averages, convergence, divergence indicator doing a bullish crossover. Position traders might opt to just buy and hold this position since it's within the markup stage, but momentum traders might buy and sell within this position. They enter at the breakouts and then they exit at the surges and then wait for price to consolidate before re-entering on another breakout. Price tried to break above base 4 but it proved to be a breakout failure. The ADX also decreased, which shows the weakening of the buyers. Eventually, the price broke down and entered the markdown stage. We also see that the moving average convergence divergence indicator also gave a bearish crossover signal at the peak above base 4. The price target for each breakout above a base can be determined by finding confluences between the Fibonacci ratio and range resistances. It is important to know that the more significant Fibonacci levels are the 382, 618, and the whole numbers. When there is a confluence between these levels and range resistances, then the price is likely to be rejected at or near that price range. When price broke above base 1, the price hit the 1.618 Fibonacci level. There was confluence with the range resistance because it was the pivot point on the last quarter of 2019. Price was rejected at that area and consolidated sideways, forming a triangle pattern. When price broke above base 2, it made a strong move towards the 2.618 Fibonacci area and also the range resistance. This became the high of base 3. A breakout above base 3 brought price to the 4.618 Fibonacci level, which was also a range resistance from the first quarter of 2019. Price tried to break above that level a number of times until it was finally able to break out. Price topped out at the confluence of the 5.382 Fibonacci level and the high of July 2019 at 15 pesos. This was the end of the markup stage.